Vinit Sambre joins us now. Let's take a conversation forward with him and let's understand what his view of the market is. Vinit, good morning. Thank you for joining us. Vinit, we're down 10%. And every fund manager who's come on the show, they've said the following: don't worry, be happy, it's a healthy correction. The problem is that if you go down another 10%, the happy feeling becomes unhappy feeling.
Yeah, Nikunj, good morning. And, I would sort of, say one thing. I think for the long-term investors, down markets are better than up markets. And I think, we've seen a linear rally the last 1.5 years. We've not seen really any downdraft. And 5, 10%, 15%, I think is something in that overall scheme of things is pretty okay, considering the fact that even after we've, shaved off about 8, 9%, if we look at the valuations, they are, pretty well justified. Our valuations are still about 1.5 standard deviation over the average. I'm not trying to justify the correction, but I think this is good in the long-term picture where we all want to participate in the companies at reasonable price points. Last 1 year was difficult doing that, and hence this correction should be okay from that perspective.
Why is that every big smart brokerage and the strategist are in consensus with this following thought that India is trading at a massive premium to the historical markets and it is time to take some chips off the table? You are getting those reports, we are reading those reports, but and markets are also somehow, and FIs are reacting to those reports. So how would you justify this call which a Morgan Stanley or a CAS or a JP Morgan or CLS is communicating to their clients that it's time to take some chips off the table and raise cash because India is trading at levels which are much higher than historical averages?
Yeah, I think so. That's the fact of the matter. But I think overall, you need two sides of the coin. I mean, you need a buyer and a seller. And I think at certain point, investors with a objective of a different kind or a timelines of a different kind may behave differently than an investor who has a totally different objective. Now, just to give an example here, Nikunj, is the banking sector as such has been at the receiving end as far as the overall, if you look at the performance of the sector is concerned, the price performance. And if you look at the fundamental performance, I think things have only improved since the pandemic fear had impacted the banking sector. Now, this is, a contradiction of some sort where, some investors are willing to exit because they are, let's say, looking at new age businesses. They want to participate in some other section of the India growth story. And some section of the investors may feel that there's a good cyclical recovery likely to take place, and hence may want to keep parking some amount of their capital into this story. So I think there's always two sides of the coin, and I think depending upon what objectives, what timelines each one has, I think people have been behaving in that manner. So I think it keeps creating pockets of opportunities for some. It keeps giving some opportunity to take money off and move into others. Good part is that India is still getting recognized in some form or fashion as remaining the high growth market. And if the capital moves out for some reason, there is also going to be capital which will seek growth and will come in at certain point in time when the valuations become, let's say, more reasonable.
I'll talk about a sector where you've really created wealth for a unit holders, which is the specialty chemical space. Now that space is turning. What is your view? Do you think the best of the gains and best of the stock market performance for the specialty chemical space, which you've been sitting on from last couple of years, pre-pandemic days actually, that story is behind us now?
No. In fact, I've had a review of most of the specialty chemicals after the results, and I think generally the long-term outlook here is still pretty good. The companies are investing for growth. That is clearly visible in most companies. Plans what they have for their future, and if I really compare. The size of our industry, it is still, let's say, 1/10 of what China is. And why I'm trying to make this comparison is the fact that India has emerged as being one of the important players in the global market, in the global specialty chemical market. Most companies are having 50% of the business coming from international markets, which means globally there is an acceptance for Indian products, and the companies have enhanced their skill, which is required to sort of meet the global demand in a way. So I think there is a opportunity. Our guys are up there in terms of their skill set. This opportunity will be encashed over a period of time. Just that in this journey, we've been investors here for long, almost 8-9 years now. But we've been also off late were slightly active when let's say 8-9 months back, when the valuations had zoomed past their reasonable numbers, we had trimmed our positions as well. But now that the stocks are corrected, some of these names are looking reasonable. Probably some more correction, and we may want to again get back into some of these names. So I think it's the story, long-term story looks good. It was just the valuation which was a bit uncomfortable. Now I think they are coming in a reasonable zone, is what I can say.
Good morning. I was reading a recent interview of yours where you also said don't look for short-term returns and don't try to be fashionable. Can I build on that point and ask you, what does that mean? Is it time to return to the cyclicals, look at value stocks? Is it, look at things like banks?
Yeah, I mean, my point was more coming from the fact that when you are actually in the thick of the bull market, there is a lot of narratives, which keeps driving the behavior. And when I say narratives, it is more to do with companies and stocks which are doing well, and which are not having very strong fundamentals to justify. People are ready to pay very high price for businesses, companies which are going to give them cash flows 20 years out in the future. Now, it's very hard to actually believe that there are too many long-term investors. Most investors who have participated now last 1.5 year, I don't know how many of them have patience to hold on to these companies for so long. So I think there's a mismatch when investors try to play the narratives, around the fact that what is the holding period, and they want to encash the short-term, let's say, sentiments or short-term behavior, which is going to drive the stock price. So I think this is a mismatch which can become risky if the markets were to take a U-turn and go for some consolidation or correction, and these type of companies can see much higher correction. So I think the question was for those investments. And I think, like you said, where we are sort of trying to look for opportunities, I think will be ones where you have a good visibility of the companies generating cash, generating good ROCs, and some of those are in the low business cycle, and the valuations are not justified as well when we look at their fundamentals. So I think getting back into the names what you mentioned, some of those makes good sense at this point.
You have in the past spoken in a very bullish manner when it comes to banks, but the banks have been taking it on the chin. Look at the recent sell-off. Do you still remain bullish on banks?
Yes, of course, I sort of continue with my view, and the story has not yet played out. There is a disconnect between the improvement in the fundamentals and the stock price. But over a period, I think we've seen that the difference between the fundamental and the valuation, it tends to narrow over a long period of time. So, and we are patient investors. It's a good time to gradually build on to the banking sector as such. And eventually, we believe that the performance should catch up with the fundamentals and should deliver good value for the investors.
Right.
Vinit, you talked about specialty chemicals in your funds, but wanted to understand, specifically in your mid as well as small cap funds, what is it that you're buying, selling and holding? If you could give us a sectoral flavor.
Yeah, so I think incrementally the overall thought process is that wherever we are seeing visibility improving, the long-term visibility, and we will keep having a lot of these variables in terms of the viruses spreading, in terms of global events happening. But I think more importantly, our focus is on, irrespective of these events taking place, which companies and businesses are showing promise, and they are actually gaining strength in terms of their core business franchise as such. And right now, if we just go by what's happening, I think there is a continuity in the capex momentum. The government is having a very strong intent of pushing growth. So I think that's clearly visible. So in line with that, plus the housing sector is doing well. Our interactions as of now with most real estate companies is suggesting continuity of decent demand momentum. And from that perspective, I think what we are sort of trying to look for are the companies which are going to be beneficiaries of those, and the segments which actually should benefit because of these two large trends are going to be, let's say, some of the good engineering companies, product-based engineering companies, consumables in the whole infra space as such. Consumables are, let's say, less volatile in their growth prospects. Then we have beneficiaries in the cement sector as such, building materials. So I think some of these, let's say, B2B plays as such, the visibility of the growth is pretty good. And the valuations are reasonable. I would not say they are attractive as such. In some cases, in some of these engineering companies, they are high. But my sense is that we are in a very strong cycle, and the earnings upgrades will surprise most analysts over the next 2 to 3 years, which will basically justify the high valuations in some cases where we have. So I think largely these are the segments where we are incrementally looking at. And there is one category of one sector which is actually underperforming today, and the businesses are not doing well, which is the auto. Within auto, I'm talking of, so we are already having auto ancillaries, but I'm talking of auto OEs. Especially the two-wheeler sector, has got impacted. We've seen the volumes, are not still coming back. But at the same time, one should also appreciate the fact it's been now 4 years of fall. 2019 was a peak for the sector, and it has got impacted because of various factors. We've seen the prices of two-wheeler has gone up significantly because of the last few years changes which has happened. Our sense is that the next 2 years the cycle should sort of come back. There will be a strong replacement cycle as well, and these stocks are really very cheap. So there's one segment where visibility of the business momentum is high, one segment where the visibility is low, but the stocks are also very cheap. So I think it could be a good mix of businesses which one can own in the portfolio.
That's quite interesting. So you've given us a great insight into what is it that you're buying and adding positions to, but where is it that you've cut positions and gone underweight in your mid and small cap funds?
So I think so there's no one category as such, but wherever we have seen, let's say, the stocks becoming really very expensive in comparison to their, let's say, next 2 or 3 years of growth prospects, I think we have took some profit out. We used to have, let's say, the large cap IT in the mid cap, which we had bought quite a while back. So we have trimmed our position within that. There are some consumer durable names which we have, which we have trimmed as such, because I think overall the valuations are pretty high, and there is some amount of demand slackness which is seen right now for whatever reasons. I mean, anyways, we've heard that rural is slackening a bit. We're also hearing that the entry level products are getting a bit more challenged in terms of the demand momentum. So, at one end, we are having higher multiple and the demand momentum seems lacking. So I think some amount of money has come from there. So I think that's how we are sort of rebalancing the portfolio as such.
Joining us, and good luck.